I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a bit of a regular guest. We have him on, probably not having him on enough. He is a money manager, manages hundreds of millions of dollars. He's a bright guy. He's got a cool name. He's from Europe. He's got an accent. His name is Axel Merk of Merk-Easiest. We love having him on. We love your brain there, Axel Merk. Thanks for joining us today on USAWatchdog.com.
Great to be with you here from sunny California.
Good. Well, I know you're from Europe, but you're working in California. Yes, Merk-Easiest. I just wanted to talk to you first off about what's going on in North Korea. I know you have to manage geopolitical risk, and we have these B-1 bombers we're sending. We have this THAAD system, this Terminal High Altitude Area Defense System that the U.S. is employing in South Korea, which is making China upset. You have threats going off from North Korea and Kim Jong-un. Meanwhile, you have the president saying he'd like to meet Kim Jong-un. It'd be his, quote, great honor, end quote. What is going on in the geopolitical arena, and how do you navigate that?
Yeah, isn't it amazing? I mean, if you're not confused, you're probably not paying attention. As an investor, of course, I don't really care what somebody likes or not likes, but it does matter to me when asset prices are very expensive of what's going to happen to them. And the thing I'm most concerned about is how a trade war might derail things. And I mentioned trade war because I don't think a trade war is going to happen because of a border adjustment tax or because of tariffs that the U.S. is going to impose. But I think it's going to happen because the Chinese are going to feel bullied or pushed by the Americans, be that because of the THAAD system in South Korea, or be that because of the islands that are being have been built up by the Chinese and the U.S. trying to push them back. I think the Chinese are going to make life difficult for corporate America, or at least potentially they might, and that sort of thing is going to have an impact on the markets, and not so much of what the president tweets or likes or dislikes about North Korea at this particular instance.
When you say have an impact on the markets, are you talking about, we due for a correction? Are you talking about destabilizing? I mean, we have sky-high stock prices in the first quarter did 0.7%. So, I don't understand the disconnect there. Tell me.
Yeah, if you can repeat that question. Sorry, I lost my earpiece there for a second.
We have a sky-high stock prices, and then we have the first quarter GDP coming in at 0.7%. So, I mean, the economy is grinding to a halt as the economy is taking off, the stock market is taking off like a rocket. What's going on? Why the big disconnect?
Well, because that's what's worked, right? If you have sold at any point in time, you're going to be lagging the market. So over the years, if you buy the dips, that's the right strategy. And guess what? It doesn't matter whether news are good or bad. It doesn't matter what the geopolitical risks are. Buy, buy, buy. What can possibly go wrong? Now, of course, at some point, something is going to go wrong. But we've had this going on for so many years that it has changed the way investors invest. It has changed the industry. The more you've been thinking in this market, the worse you've been performing. So the monkeys are the best performers in this sort of market. And so there is a huge disconnect. And yeah, at some point we're going to come back down to reality. I would allege that most investors are way overexposed to what is generally called risk assets. That includes equities, but also includes fixed income. Many people don't invest in bonds that yield nothing. No, they found some smart way of investing, mostly in the junk bond arena. And guess what? Junk bonds are highly correlated with equities. And so this so-called diversified portfolio doesn't exist in practice. I would allege that too many people are overexposed to equities. And so, yeah, at some point, the market is going to think the glass is half empty. And at that stage, I think there are going to be a lot of tears.
When you talk about how the glass is half empty, you've talked in the past about how there are no safe havens. There's no safe assets. What do you mean by that?
Well, historically, in your traditional portfolio allocation, you have stocks and bonds, and then you can go to cash. Well, what about if your cash isn't as safe as it used to be? And I'm not suggesting that the government is not going to pay back its treasuries. You might get a delay with a government shutdown, but the purchasing power of your cash is at risk. When you have a 20 trillion in debt, your purchasing power is at risk. And so what I say is, well, throw out that risk-free asset. Do your asset allocation, realizing there's no place to hide. And once you do that, it's kind of freeing you up. You can diversify to cash around the world. You can try to juggle that. You can do it with gold. You can try to do it with other things. You can go short or something. The point is there is no safe place. And once you recognize that, you will see that, yeah, the government is not going to bail me out by having some sort of safety net, be that I'm not just suggesting a social safety network, but just that cash is not the safety net that it used to be. And so once you do that, yeah, you're going to look at your asset allocation a little bit differently.
Well, do you think that we could have actually a freezing system? And Jim Rickards, who's a bright guy, I like him, and he says that the system is at some point is going to freeze. It's going to shut down. Do you think the same thing? Do you think we're going to have a freezing system?
Well, it depends on what freezing means. And I love Jim, but I think as much as Jim criticizes the system, he believes in the system. I have the mic now, so he can't contradict me, and I'm sure he's going to disagree with what to say. But he kind of believes the system is going to collapse, and then the IMF or some organization, a group of countries are going to put the pieces back together. I'm actually far more pessimistic. I'm saying over the past 100 years, we have moved further and further away from the gold standard. I see no end in sight in that. Everybody's in it for their own. I mean, the Europeans can't even agree on a single currency on what to do with it. So I don't think the IMF is going to agree on anything. And so if you move down that road, you're just completely on your own. And I think that's the far more likely scenario. No, freezing. We're going to continue to live. Even if there's a war, some folks will continue to live. Already in the early 2000s, I warned about rising income gap, about moving more towards a Latin American society. Or, for example, people turning 65 used to retire. Now they can't retire anymore. But we used to think that's a bad thing, whereas in a few years from now, if you talk to a 65-year-old, they're going to say, yeah, of course, I can still work. I'm a contributing member of the society. And so society adapts. And so because of that, and if you do have a financial, quote-unquote, meltdown, well, we know the playbook. And the playbook isn't the same throughout the world. The Europeans like the austerity. We like to print money. The Japanese have Abenomics, and the Russians are trying to show their strength otherwise to distract from issues. We do know that we have rising populism when people get upset. We do know that the last time we had something like this in the 1930s, it didn't end too well. But freezing, I don't know whether freezing is the word I would choose, because there's always something next. And it's that something next that we as investors got to figure out. Where do you put your money? Where do you hide your money? And how do you allocate your asset to try to either not lose so much or to actually make money of whatever crisis might be coming?
Now, I don't want people to think that you don't like gold. You do like gold, and you have called it, quote, an easy diversifier. Explain what you think of gold and what the term easy diversifier means.
Well, sure, yes, I very much, I do have gold. I do have it both in physical form and in exchange traded form and other means of investing in gold. But yes, I say it's the easiest diversifier. It's not always the best diversifier. And again, I do like it. But the reason I say easy rather than best necessarily all the time is that if you do a portfolio allocation, what you want is something that has a positive return and that has a low correlation to what you have. And in the long run, gold has proven that, and obviously who knows what's going to happen tomorrow, but since the early 70s, gold has had an annual return of about 8%. And going forward, people are always worried about, well, but it doesn't pay any interest. Yeah, well, maybe that thing paying interest doesn't really pay your real rate of return, because otherwise gold wouldn't have had an 8% return a year. And even as the Fed is raising rates, I happen to believe they're going to be behind the curve. So I happen to think, yep, gold is going to be doing just fine because we can't raise rates too much. But as far as diversification is concerned, versus equities, the correlation of gold has been 0.00. So that seems like the perfect diversifier. That said, on a daily basis, of course, gold can be correlated with other assets. It can move up with the S&P together. It can move down with the S&P together. It doesn't always move independently. And that's why I call it the easy diversifier. The ideal diversifier would go up and almost always be uncorrelated. And that's very difficult to get. What you really now need to do is you got to move to some sort of exotic strategies, long short equity, long short currency, something that for most investors isn't accessible. And that's why gold is the easiest diversifier. Very much I like it, but people do have to be aware of its limitations in that sense, that, yep, if you do have equities and gold, there will be days, there can even be months, when both of them are going to move in tandem. And of course, that's going to shake off some investors who thought that gold is always going to do well. And as we all know, that gold doesn't always move well. The gold doesn't change, of course. The gold has always been the same, but the price of gold can be correlated to other assets in the short and medium term.
And you got to talk something about silver. We have a lot of people that invest in silver. A lot of people call it the most volatile metal, that if gold goes up, silver will go up many times higher. What say you?
Well, it's a question of how much volatility can you stomach, and it's a question of understanding the dynamics. Gold is simple. Gold has some industrial use, but it's mostly used as an investment asset, whereas when it comes to silver or other metals, you have much more industrial use. And so as a result, when the economy doesn't do well, the dynamics in silver are far more complex than those are in gold. And by all means, I happen to agree that if the price of gold were to go up substantially, the price of silver might also move up, but it's going to be a more volatile ride. And there will be periods when silver significantly underperforms because of that industrial component that is just so much more significant. And so to me, gold is plenty complex. But yes, in the medium term, I think silver should also do just fine.
What about the budget, the process? We just got a budget that we strung it out to September. The Democrats are partying. They got their funding for all kinds of Obama stimulus. And Trump is now saying that, hey, maybe we just need a government shutdown. What do you say about that on there? It looks to me like we're setting up the perfect storm for the fall of 2017 to get some very shaky action out of the markets. What do you say? How do you navigate that?
If nothing else, it keeps the journalists busy guessing of what's going to happen next. I mean, isn't it amazing? But all joking aside, these October budget deadlines are actually taken very seriously. And it's not so much that I'm too concerned about a government shutdown. If that were to happen in the past when we've had it, the markets haven't fallen out of bed, although you never know what is going to derail the market. I happen to think these markets can be tipped over by anything. And with hindsight, I'll tell you whether it was the shutdown there or something in the South China Sea, or maybe just some leader coughing somewhere. But more importantly, I think, is that in these October deadlines, some real reform can be pushed through. Remember, nothing gets the administration moving like a good crisis. And so when you're a few seconds before the shutdown, suddenly members of Congress can slip provisions into a bill that would have been impossible to pass otherwise. And so that's really the time when real reform can happen. Now, clearly, when things can happen the last minute and with a lot of stress, odds are Washington is going to mess it up. But still, those things are not to be underestimated, because that's when you can actually push real reform through. You have the threat of a shutdown, of a veto, of this or that. And so, yeah, we got to keep our eyes open. And as an investor, always keep in mind, we do that in a backdrop of the lowest volatility as we speak in 10 years in the markets. Well, anything that moves that volatility higher could provide some very significant headwinds to equities.
What do you look for when you're looking at to tell you if the market is risky or the market's not risky? I know you have exited the markets in years past. What do you look for? What's your history of saying, okay, here's what I'm doing. I'm getting out of the market now, whatever. You've done pretty well investing. You've been able to zig when everybody else zagged. Tell me what you look for.
To me, complacency and expressed as volatility is the best bubble indicator. And so in the late 90s, got mostly out of stocks. In 2007, got almost entirely out of stocks. And the reason was that you were in this Goldilocks economy. I remember in 2005 and 2006, Goldilocks appeared more frequently. Of late, it's come back. Now, it's difficult to time exactly when the top is. But the thing is, when volatility is low and asset prices move higher, well, guess what? Rather than just investing in these assets, why don't you take out some leverage? Because it's going to work even better. Because, hey, when volatility is low, what can possibly go wrong? Well, clearly something will go wrong at some point. And then when people have used leverage, the kind of the downward spiral in equity prices is going to be all the more severe. And so at the very least, I would encourage people that as things go up, you take some chips off the table, you rebalance. And people haven't done it because there's nothing good to put it in otherwise. And so instead, people are trying to buy insurance or this or that. Well, cut it out. Just be honest, keep it simple. Take some chips off the table, and if nothing else, hold some cash. That's probably better than many of these exotic things that are available. But yes, I happen to take things more aggressively simply because I can afford to be more aggressive in my risk profile. And so right now, and this may change any second, of course, because I can't predict what I'm going to do if somebody listens to this video in a year or two from now. But I happen to have an exposure in my personal portfolio that's neutral to negative on equity. So I've taken it all the way to actually have a slight negative negative tint on the markets. And it's not so easy to do these days, because whenever you're negative on the markets, it's going to cost you an arm and a leg, buying insurance or whatever it might be. But I happen to think that just because somebody like Mr. Gundlach says that you cannot have a market crash if there's no recession, I think he's missing the point that in 1987 that just happened. You had a bear market in 1987 without having a recession. Some recession, it depends on who you look at, but some recession indicators are saying, oh, we're not going to have a recession anytime soon. That does not mean you cannot have a negative event in the markets.
Well, what do you think about this GDP print that is giving us it's 0.7%? I mean, the Atlanta Fed pegged it at 0.2% GDP growth, and yet we have a spiking stock market. Is that what you're talking about the markets are going way up and the complacency is way down? You're saying that this is a warning sign that you should be looking at this as a sign to get out?
Well, interestingly, as we run our business, we get research reports from all kinds of people, and some are wildly bullish and some are wildly bearish. It turns out almost all of them are pretty smart. And so what the heck, who do you believe in and what do you do? And ultimately you got to make up your own mind, and then it comes back down to, yep, you just got to manage your risk. You got to manage your investments. And many people think, oh, I'm going to get out of these things once prices come down. Well, very few people in early 2000 thought prices are going to come down. Very few people in 2007 thought prices are going to come down. With hindsight, yeah, you can, once the market is down 20%, somebody on CNBC is going to tell you you've had a bear market. If you want to invest when prices are down, you got to create liquidity. You got to take chips off the table when times are good. You cannot double down at the end of 2008 if you've lost half of your net worth. You can only do it if you've taken some chips off the table in the period leading up to 2008, so you then have ammunition to buy it. And so there's a saying that the wealthy person can afford to be on the sideline, whereas the poor person always wants to chase the latest trend, and with that is always going to be late to the party and is always going to lose money. Whereas the poor person, if they pursued a wealthy person strategy, could also become wealthy.
I want to talk to you about Donald Trump's budget. You know, they want to cut taxes, corporate taxes, to 15%. They want to expand the deductible for a married couple. They want to make it a lot simpler, the tax strategy. They want to rev up jobs. My worry, some people worry that the good news is Trump's going to be successful. The bad news is Trump's going to be successful. I've said this, that he might, blow up the dollar or blow up the bond market. He's definitely going to expand the federal deficit. What do you think about that scenario? Could he get the economy going and we take a little bit more debt, or could he blow up the bond market, blow up the dollar by taking on more debt?
Well, after the election, the markets jumped and priced in substantially higher real growth. Finally, we're going to get rid of these regulations. Finally, we're going to have a tax reform and so forth. And sure enough, governing is a tad more difficult than campaigning. And so what I have been saying is that we're going to replace some of those higher real growth expectations with expectations of higher inflation down the road. And yes, we might, especially if it works now with the Democrats, we're going to get some more spending done. But what we really need to get done is entitlement reform. We got to get our deficit sustainable. I don't have any problem with us piling up a little bit more debt in order to boost the economy, and if we do make some structural changes. At this stage, I'm a little reluctant to think that we're going to get tax reform. I think we're going to get tax legislation, because many of these ideas are going to be watered down so much that who knows what they're going to mean in the end. What we have to do is we have to change the tax system so that corporate America doesn't move their headquarters abroad anymore. If they fail to do that, then I'm very negative on how this is going to play out. Now, odds are they're going to try to achieve that somehow. But they do have to pay for things somehow, and I'm not going to be a stickler that has to be paid for one. Although, of course, with the budget reconciliation process, at least on paper, they have to show it. The question is what sort of structural changes are going to happen. If you can depreciate all of your expenses in the first year, that's a huge boost to investments. If they make it easy for people to take back the money, corporations, that would be fantastic. But they should not do it a halfway job. If you punish money coming back, people are not going to take money back. And so there are some simple things they should be able to do. But at the same time, nothing is simple in Washington. And so from my point of view, I happen to think things are going to get watered down, deficits are going to increase. We always vote for change, and then at the end of the day, we're not going to get so much. One of the problems of doing everything with executive order, as we've seen now as well, you can undo it. The next guy or gal can change it all again. And so we really need to fundamentally change the legislative process, and I don't think that's going to happen.
Axel Merk, you also have a Twitter account, and you have these. Of course, you have a Twitter account, but you have these webinars, and you have them on a pretty consistent daily basis every month. And you let people write in, and they're pretty well attended. Tell me about how do people get a hold of your next webinar that you have coming up?
Yes, sure. Well, first on Twitter, I happen to think Twitter is a great invention because you can create your own news channel. If you see a report you like, look at the journalist, look at the writer, follow that person on Twitter. You can get your own news feed. I contribute to that. Axel Merk is my Twitter handle, AXEL-MERK. So follow me on Twitter, and you'll get the most instantaneous interpretation of the news. If you want to get more in depth, one of the things we do is we do webinars. We try to have them once a month. Most of these webinars on specific topics. Gold tends to be one of the more popular topics, but we do other topics as well. We have one coming up on just portfolio construction, how to invest in an environment where asset prices are highly correlated and ever rising. But if I mean the audience here listening, has a suggestion, we'd love to hear from you about what we should have a webinar on. We'd love to take that sort of input, and then your topic might just be the one of our next webinar.
It's like having your own, high-powered investment manager you can talk to. I mean, it's a pretty cool thing. Pretty cool thing. Well, I'll put all the links on after the interview section, and I'll put your links to your site. You also are a writer and a fairly prolific writer, and you give free analysis on Merk Investments. What is it, Merk.com? What is your website?
Merk-Investments.com.
Yeah, Merk-Investments.com. Merk-Investments.com. I'll put that all up. People can follow you on the website, on your Twitter account. Axel Merk, thanks for joining us today on USAWatchdog.com.
My pleasure.